a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about 3 excellent ETFs for your IRAs. So the tax filing deadline of April 15th is now less than a week away. So you just have a few days to contribute to your IRAs for 2023, or you can start contributing for 2024 IRAs if you have already met the limits for 2023. It always helps to dollar cost average. So first of all, investors should have a plan for saving for their retirement, and that plan should also consider opportunities to manage taxes, but not basing decisions entirely on taxes. Sorry. So talking about the IRAs, some prefer traditional IRAs and many others prefer Roth IRAs. So both these retirement products, they provide some amazing tax benefits. So contribution to traditional IRAs can be deducted from taxable income, but you'll owe taxes when you withdraw money in retirement. With Roth IRAs, there is no upfront deduction, but withdrawals can be made tax-free. Now, these IRAs allow investors to buy stocks, bonds, ETFs, mutual funds. Now, ETFs are becoming increasingly popular because they provide opportunities for investors to get low-cost exposure to a diversified basket of stocks. Now, further, income-paying ETFs are better suited for an IRA because income is either deferred or sheltered from taxes. But in general, when you are saving for retirement, you should look for funds that have high quality, low cost, and provide broad, diversified exposure. So with that in mind, I have 3 excellent picks for you today. So the first ETF that I'm highlighting is Spider Portfolio S&P 500 ETF. This is now the cheapest S&P 500 ETF. So again, when you're saving for retirement, look for low costs because you're saving for the long term and costs can add up over the long term. This charges just 2 basis points. And we know that there are other S&P 500 ETFs, some excellent ones like VOOIBB that charge 3 basis points. So 1 and 2 and 3, not a lot of difference, but why not save that 1 basis point when you are getting the same S&P 500 exposure in this ETF? And AUM is close to 34 billion now. So let's go to the quote page on Zacks.com and take a look at this ETF. You can read our research report articles. Basically, you can use the link to go to State Street webpage for this ETF. So this ETF used to track another index before 2020. So before 2017, this used to track another index, and until end of 2020, this used to track SCHD, a large cap index ETF. And since 2020, they changed the index, and now it has become the cheapest S&P 500 tracking fund. So this is the cheapest, which is mentioned over here. Now, if you look at the holdings, yes, those familiar holdings, Microsoft, Apple, Nvidia, Amazon, Google, and Meta platforms, we all know these are the top holdings in any broad S&P 500 tracking ETF or NASDAQ tracking ETF. And there's a lot of talk about concentration risks because these top 10 holdings now account for more than 30% of the portfolio. But I wouldn't worry so much about concentration if you are a long-term holder, these are all high quality companies. These are profit machines. They are going to be fine over the long term. So if you're a long term holder, you need to have exposure to an S&P 500 ETF in your core portfolio. Now, the second ETF that I'm highlighting, I'm focusing on income, and I'm focusing on the quality of dividends. So this particular ETF, very popular with 55 billion in assets under management by Schwab. This holds 100 dividend-paying stocks, and the focus is on quality and sustainability of dividends. Expense ratio is just 6 basis points. Again, let's go to the quote page on Zacks.com. So this is the ETF. If you look at the index that it tracks, so this selects high dividend paying stocks that have a record of consistently paying dividends. So sustainability and then quality, they are selected for their fundamental strength relative to those peers. So it applies a number of fundamental screens to select those stocks. And with that, look at the exposure that you get. So I talked about the concentration risk and top heaviness of your top 10 holdings in your S&P 500 ETF. Here you're getting slightly different exposure. So the top holdings are Chevron, Lockheed Martin, Verizon, Texas Instruments, etc. And in terms of sector exposure, also you're getting slightly different exposure. Let me go back to the sector allocation for the S&P 500 ETF real quickly. So information technology is almost 30% in the S&P 500 index, and then you have other sectors. In this particular ETF, you're getting a lot of exposure to these cyclical sectors which have been doing well lately. So as the economy has been doing well and the Fed is expected to cut interest rates sometime later this year, these sectors should do well. So industrials, financials, they have been shining lately, and you get a lot of exposure to those sectors in this ETF. The third ETF that I'm highlighting here is by iShares, and it is the iShares Core High Dividend ETF. Ticker symbol is HDB. This holds 75 dividend-paying stocks, and this also screens for quality and sustainability of dividends. Pretty popular with more than 10 billion in assets, and this is also very reasonably priced at 8 basis points. And in full disclosure, I own it in the ETF investor portfolio that I manage. Now, really quickly, I wanted to mention that the yield that you get on SCHD is 3.4%. So again, it makes sense to hold it in the IRA account because of this, the level of yield. Now, looking at HDV, the yield you're getting is the same, almost the same, and pretty similar strategy as well. So this, the index that it tracks also provides exposure to high quality companies that have strong financial health and ability to sustain above average dividend payouts. So with that in focus, you are getting exposure to 75 holdings here. And let's take a look at the holdings. So again, your exposure is quite different from your typical S&P 500 or NASDAQ 100 ETF exposure. So you're getting a lot of exposure to Exxon and Chevron, the energy companies, and then telecom companies, healthcare companies, etc. If you're looking at the sector exposure, 27%, more than 27% exposure to energy. Now, energy has been outperforming this year, particularly over the past month or so, since we saw rising geopolitical tensions, particularly in the Middle East region, and concerns about oil supply. So, oil stocks have done quite well. And in fact, they have done well over the past 3-4 years or so. But despite their outperformance, energy gets just about 4% exposure in the S&P 500 index. So if you are trying to diversify away from just technology stocks, this particular ETF provides exposure to a lot of other sectors like energy, consumer staples, healthcare, etc. So you get some diversified exposure and a nice dividend yield and also quality of those dividends. Now, on the next slide, I have the comparative performance of these three ETFs over the past year. So because mega cap technology stocks did so well, so obviously the S&P 500 ETF is the best performer over the past year, up almost 30%. And then you see SCHD and then HDV. But over the past month or so, all these areas that these two ETFs, the last two ETFs provide exposure to, have been doing well. So these two ETFs have been doing well, quite well lately over the past month or so. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. And I'll see you next week.